I'm Greg Hunter. Welcome to USAWatchdog.com. With us, economist John Williams at ShadowStats.com. Joining us from a sunny California. John Williams, thank you for joining us today on USA Watchdog.
Thank you for having me, Greg.
Let's start with the GDP numbers. You've been predicting that the economy would be slowing down to the point that they will likely begin another round of some sort of QE, even if they don't name it that. But first quarter came in 0.2% growth. That's the best they can make it look. And you're forecasting that the revisions are going to turn this thing negative. Please explain.
Well, the GDP number comes out in three estimates. The first one, which is the advanced estimate, the one that came in at 0.2%, the Bureau of Economic Analysis is guessing at, and they tend usually to try and target whatever the consensus is looking at. Well, the consensus forecasters was looking at 1% growth, but keep in mind that the general consensus forecasts, or the people who generally make those forecasts, are employed by Wall Street, and their firms need positive news, good investment news. So they're very slow to catch downturns in the economy. It's unusual that the GDP growth estimate would be so much weaker than the consensus. That was a signal from the Bureau of Economic Analysis to the consensus that, hey guys, the economy is a lot weaker here in the first quarter than you thought it was, or that your consensus is indicating. Now, 0.2% was absolutely the lowest number they could use and still have positive growth. You say, well, they could have shown 0.1%. They did that in a similar circumstance last year, and then they took it negative. The reason, as I see it, they didn't take it to 0.2% is that because of the low inflation, actually had somewhat negative inflation in the first quarter. The nominal GDP, that's as a cash register would show it before inflation adjustment, that was up only 0.1%. That was at the minimal level of 0.1%. Now, since that number came out, the trade deficit widened sharply, and although some of that had been built into the government's estimate of the GDP, the number on, I believe it was Tuesday, was such that they'll have a downside revision to this first quarter estimate that'll take it negative. And what we're seeing now is that the outlook for the second quarter is not only weak, but it's also going to turn negative. 2 consecutive quarters of contracting GDP gives you a recession. And what I'm looking at here is that come sometime between now and July 30th, when they first estimate the second quarter GDP, that the markets are going to be looking at us being in a new recession. You're going to see a lot of numbers in the weeks ahead: retail sales, industrial production, housing. We have a full quarter's worth of reports ahead, but the monthly numbers will tend to be weaker than people are looking at, and it will move the forecast for the second quarter down. So that you're going to have an outlook for recession. This is an economy that I'll contend never recovered, but now we're in a new recession. I'll contend it's just a continuation of the old one, sort of a non-down leg, or a double dip in a grand economic contraction. Not what the Fed wants, not what the market wants. All the speculation about the Fed raising interest rates, returning its policies to more normal functioning, which had been the basis of dollar strength since last June. That's gone. It's going to be very difficult for the Fed to raise interest rates with the economy turning down again. And you're already beginning to see some downturn in the dollar, which should be reflected in higher oil prices, which will spike inflation. Also should be seen in higher gold prices, which, although they're still manipulated, will tend to be moving a lot higher.
That's good news for the people who have been sitting on gold since 2011. But I want to just backtrack just a minute. I heard you say we've started a new recession. Did I get that right? You're calling a new recession right here and now?
Well, that's the way it's going to be viewed. My contention is It's an ongoing economic downturn that we entered way back in 2005. This is something close to a depression, but in terms of the way the markets will view we're in a new recession.
And all the happy talk about raising, interest rates and a dollar going up, you're saying forget about it. No way.
I don't see that happening. The Fed, let me put it this way. The Fed's quantitative easing was never designed to support the economy. That was the popular story. Oh, the economy's weak, therefore we're pumping a lot of money in, we're keeping interest rates low. Low interest rates are not necessarily good for the economy. In fact, if interest rates are higher, that has some pluses, such as banks can generally get better profit margins on their loans, which means they're going to take on higher risk loans, and that puts more credit into the system, and that generally helps expand economic activity. Banks haven't been lending normally. People who live on fixed incomes, retired people, used to be able to make some kind of an interest income level that was meaningful, putting their funds, let's say, in certificates of deposit. Right now, you can't get a safe investment in interest rates that's has positive return. Let's say if you look at 2% inflation, which Fed targets, and we've seen aberrations with the oil prices. Generally, net of inflation, interest rates, the short-term interest rates are negative. So you're losing money by doing that. You can't live on that. So it's the low interest rates do hurt people, does hurt the economy, but the Fed's keeping the rates low. It's kept the funds in the system. The quantitative easing generally has been aimed at helping to support the banking system. Keep in mind the Fed's primary function is to keep the banking system afloat. Yes, they're supposed to help keep the economy going. They're supposed to keep inflation under control, but their primary function is keeping the banks afloat. Quantitative easing has been aimed at helping the banks, and they've used the weak economy as political cover for doing that.
Janet Yellen was out, and people just guffawed. She actually told the truth. Isn't it a weird world we live in when the Federal Reserve Chairman tells the truth? People are shocked. And she said that the equity markets were, quote, quite high, and then she talked about it being a danger. And last week, the market sold off, and there was it seemed to me there were reports out the next day, I believe on Thursday of last week, that that there were bond buying going on, that they were hitting a panic button. Did the Fed chief, did she just make a mistake, or did she have a reason for saying that, whoa, the equity markets aren't very good and there's danger? What do you suppose is up behind what she said? Did she just make a flub and didn't continue the lie, or what?
Well, I'm sure she knew what she was saying. Normally, Fed chairmen don't talk about things like that because they're chairs. She's the Fed chair. For the reason that they can be very disruptive to the markets. On the other hand, the Fed has been doing everything it can to prop up the stock market. The quantitative easing, all the stories, the rumors have been played very carefully against the market. The wording in the Federal Reserve, the Federal Open Market Committee communiques. The wording has been done to try and be as non-disruptive as possible to the markets and as positive for the markets where they can. Having a strong stock market has been something that the Fed has viewed as one way they can help the economy, because in theory you'll have people will become wealthier, and you have a wealth effect. If people are worth more, they'll tend to spend more, which helps the economy. It's not working. This is not... You're not going to save the economy by having the stock market high. The Fed's done what it could to prop. Maybe she's feeling that it's getting a little bit out of hand and didn't want to have a crash. I think you're going to have a crash here somewhere along the line that's going to be of a magnitude that will be remembered for decades.
You are thinking that, and I want to come back to Janet before we continue with that, but is she sending a message to the market that, hey folks, look out below? Is she sending out a warning, or did she just make a mistake?
Well, I think she was sending out a warning. I mean, what she did was deliberate, Generally, it's a bad idea for Fed chairs to talk about the stock market. It's very difficult to gauge how comments will go. I mean, the fact they have these press conferences after the FOMC meetings is a horrible idea. They used to not have anything like that. They didn't even put out much of a statement. They just, changed policy or didn't. The reason it's a bad idea is that the markets are so speculative. You have so many people playing games with it that you can't really anticipate what kind of an impact you're going to have. And you don't want to be disruptive to the markets if you're the Fed chairman.
But she was sending out a message in your mind.
I think she wanted to be in a position of the stock market crashes. She said, well, see, guys, I was warning you.
And you think a crash is coming. There are lots of folks that think that it's not going to make it past this fall. I was talking to Catherine Austin Fitz, and she says, there's a lot of confluences that are coming due, this fall. Another budget negotiation, which is going to be ugly. The TPP, the Trans-Pacific Partnerships, they're going to want to be doing that. There's the SDR thing may, they may be coming up with some new policy with the special drawing rights policy. That a lot of people think that this fall is bad juju time. What do you think?
Well, a couple of things. First, I've given up trying to time stock market moves. I gave that up some time ago. I don't know that it's really timable. Certainly panics are not. They're by nature. They tend to be irrational movements. But back in, I guess it was the mini crash in 1989, I retained a mass psychologist to try and assess for me why do you tend to have stock crashes in October and November. We look at the crash in 87, the crash back in 29, and he came back and he said that basically humans have a vestigial squirreling instinct. Come the fall, and the squirrels go out and start gathering acorns for the winter. Same thing happens to humans. They used to do things like that too. It's still on a, you get a little more cautious. And look, I'm a big guy. I tend to break antique chairs when I sit on them. It's not that because I'm a big guy, I break them every time, but I put enough pressure on them that if a chair's weak, it'll go. This is a factor in the fall timing. If everything else is in place, it's a factor that can push it over the edge. So that traditionally in the fall you have the bad markets, but this is a type of thing that can happen at any time with a shock development. The markets still aren't looking at a recession. They're beginning to. There are a lot of people who are beginning to look at it. But if you have some really bad economic statistics, and you're going to have some in the next month or two, there could be something there that will. I'm still looking for a trigger of a heavy, massive decline in the dollar, panic decline in the dollar. That could be a trigger for a stock market crash. Any number of factors can do it. Not going to have much warning when it does come. The panic moves are almost impossible to time because of their nature. But the fundamentals are there.
The fundamentals for a crash are there, is what you're saying. Right. That there's a lot of pressure building up and they could blow up.
Where the markets are, where expectations on the economy are so far removed from reality that something's got to give. I mean, if you were moving along and the markets were realistic and the consensus outlook was realistic, you'd be less likely to get a shock. But we're not seeing reality here in terms of what the markets are looking at.
And for a while, you were calling for, the dollar to sell off, and all of a sudden the dollar starts going up, and boy, you look wrong, and I'm not giving you a hard time, but boy, you look wrong. All of a sudden you're looking awful right, because I think what I think is setting in is the idea that, oh my gosh, the Fed can't raise rates. They're never going to be able to raise rates. We're having paltry numbers and negative revisions, and what's going to happen when the herd realizes, oh, they can't raise rates. What's going to happen to the dollar? And you're going to be looking awful right here.
Well, that's why you've seen some weakness in the dollar in the last couple of weeks, last month or so, as the economic outlook has dimmed and the expectations for the Fed raising interest rates has been pushed off into the future. That's been a major factor behind the unfolding dollar weakness. The dollar is still a lot stronger than it was a year ago, but the downturn in the dollar has started, and as this becomes a very severe downturn, it's very obvious that we're in recession. The Fed is not going to raise the rates, and the moving interest rates is a traditional central bank if it wants to strengthen or weaken its currency. And where the expectations were that the Fed was going to raise rates, and that helped to boost the dollar. As you should indicate, here's the expectations shift towards no interest rate increase, and not only that, but more likely even something along the lines of a QE4. They can't cut rates much, but work towards debasing the dollar, very heavy selling of the dollar.
And so what you're saying, if you added all this up, this will be my last question here. If you add all this up, weak first quarter projections, it's going to be a weak revision into the negative land. You think the first 2 quarters will be negative, which is also what Paul Craig Roberts thinks will happen. The first 2 quarters, the former Assistant Treasury Secretary Paul Craig Roberts, PhD in economics, he's on the same page you are. You said the same thing, that the first 2 quarters are not going to be good. It's going to start turning down. And but once it starts really picking up speed, where they really know that we're in trouble in this next quarter, the second quarter, do you think they'll come out with some sort of QE4, some sort of money printing? And if they do, what will be the effect on the dollar?
Well, yes, they will. It's not going to help the economy. Again, they'll be using political cover to help support the banking system. Unexpected economic weakness here adds stress to the financial system. It also tends to widen projections on the budget deficit. It'll make Treasury fundings more difficult. The Fed's going to need to be in there monetizing debt, doing what it can to prop the banks, and that's all bad news for the dollar. But as the dollar weakens, that's going to be inflationary. As the dollar falls, oil prices will continue to rise. Gasoline prices are going to go higher again. That's where you're going to see early stages of inflation. And as the world gets used to the Fed debasing the dollar, you're going to see intensified selling. Watch for a massive decline in the dollar there, which will begin to trigger a very heavy upside to the play, and also contend the early roots of a hyperinflation in the not too distant future.
Now, you have pushed that back. You said by 2014 you'd be at the beginning of hyperinflation. That didn't quite work out. We had a rising dollar, which was a little bizarre.
Mid-year, the dollar soared, and that's not an environment for it.
But now you're seeing your scenario. When you're early, you look wrong. But now you're seeing your scenario of hyperinflation beginning to take off this year in 2015. Is that what you're saying? That's
in place, and it's looking better as the dollar weakens. See massive dollar selling. That will start the early phases of it.
In 2015, right here and now.
Yeah. The point is that first you have to have the sell-off of the dollar, the panic sell-off. That, I think, is beginning to unfold. So that's the first stage of it. And as that happens, the rest will start to unfold after that.
The Fed, in your mind, is it just trapped? Don't they have the revolver out and they're going click, 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 click? Are they out of bullets?
Yes. They have been for a long time. We had a panic back in 2008. People forget this. The system was on the brink of collapse. 2008, that wasn't that long ago, but people forget. The system, almost as we know it, came to an end. They did everything in their power, and I'm talking the Fed and the federal government, and then expanded around the world with cooperative central banks. They did everything in their power to prevent the system from collapsing. I would have done the same thing. We should not have been in that circumstance. It was due to decades of abusive policy by the federal government from a fiscal standpoint, letting the budget deficits and the future budget deficits obligations run wild, and by the Fed, particularly under Greenspan, and encouraging debt expansion, consumers taking on home equity loans to build debt leverage upon debt leverage, because people's income wasn't growing fast enough to support the economy. What happened in 2008 was a day of reckoning. They were able to cover it up and push it a little bit into the future with massive infusions of cash. They did everything without regard to future implications of what they were doing. They did nothing to address the issues. The deficit's getting worse, despite some short-term headline cash things. The economy's getting worse. The banking system still is not normal. All those factors did not get improved, and we have all those factors that brought us the day of reckoning back in 2008 still hanging around, and the Fed's got that to deal with. There's no way they can get out of this, and I can see it's just a matter of time before the dollar begins to reflect the impossible circumstance here, flight from the dollar, heavy inflation, working its way into a hyperinflation.
So the next time we have a calamity, we get the collapse we get the continuation of the collapse that they stopped in 2008. Is that right? We get a collapse next time up.
We still have that coming. Now, and they're certainly they're going to do everything they can to try and push it off as they did before, but a lot of the options are gone. I mean, they can't do it the way they did it before. That's so we're maybe they can push it ahead by another month or two. I don't know, but they're not going to get. That was 2008. Here we're in 2015. They picked up 7 years. It's longer than I thought they could have done it, and they almost lost it last year. That's when they had all the funny games that were played. So
but you think the next shot is a collapse?
Yeah, that's effectively where it's headed. Good chance of that.
John Williams, shadowstats.com. We'll be putting links up to your homepage. You have a subscription. You have free stuff on your front of your page, which is nice for people. But you also have a very detailed subscription service, and it costs $175 a year. Is that what it still costs?
Yes, we also offer it for $89 for 6 months.
I'll tell you, I think I've said this to you before off camera, but I'll say it to you on camera. I mean, I've read your reports. They're very detailed. And I know why hedge funds and billionaire money managers and people like that, I know your client list is secret, but I know why they pay for it. They probably think, wow, what a deal. So anyway, thank you so much for joining us today. John Williams, shadowstats.com. Appreciate you coming on and taking us all to school about what's going on. Thank you, sir.
And Greg, again, thank you for having me on.